The complicated mergers and acquisitions industry is perfectly characterized by Charter Communications' unsolicited bid for 100% of Time Warner Cable. Charter's first offers to Time Warner took place in June of last year and again in October. Management of the two companies negotiated privately but were unable to come to an accord. On January 13th, Charter took a different approach by bypassing Time Warner's board of directors and appealing to shareholders directly for a share price of $132.50 for a total deal size of $61 billion. This bid was also rejected outright by Time Warner management as a lowball offer, but the Time Warner board and key shareholders of the company still appeared to be willing to make a deal at a price closer to $160 per share. Another issue to contend with is a stock-cash mix of proceeds used to fund this purchase. Currently, Charter is offering $83 per share in cash and $49 per share in Charter stock, an arrangement that will grant Time Warner shareholders approximately 45% ownership of the newly formed company. Time Warner management and shareholders would like to see at least $100 per share in cash. A successful merger would create the third largest pay TV provider behind Comcast and DirecTV, and is unlikely to face much opposition from the Department of Justice, as the two companies do not compete directly in the same markets. A compelling development in the stalled deal are the upcoming elections for the Time Warner Board of Directors. As opposed to staggered elections, in which only a certain number of board seats are up for bid at once, all 13 seats are available for takeover with the upcoming election. Charter is planning on nominating candidates for all 13 seats in the coming weeks, and a victory in a substantial number of them could significantly improve Charter's chances of closing a deal at their desired price. In recent equity market news, action camera company GoPro announced plans for an IPO on February 7th. The company filed its paperwork confidentially with the SEC as a means of protecting the valuable information that must be exposed when going public. This does give some insight into the company performance though, as the company must have less than $1 billion in revenues in order to register privately as GoPro has. The decision to file confidentially highlights some of analysts' primary concerns with the company's future profitability prospects. While GoPro's known profits and growth have been impressive, the lack of a real competitor in the durable, go-anywhere camera industry worries investors about the effect that an inevitable entrant to the market would have on GoPro's sales. Another concern is the dependence of the company's success on a single product. Skeptics doubt CEO Nick Woodman's ability to continuously deliver sufficient improvements to the line of Hero cameras to entice customers to continue purchasing. A past financing deal with a subsidiary of Foxconn Technology Group valued the company at $2.25 billion, with a $200 million investment acquiring just under 11% of the company. If a public offering is approved by the SEC, more details will come to light about the company and its financials in the coming months.